Choosing the right type of order for a trade that you are wanting to place could be the difference between a trade's ultimate success or failure, so it is important to understand each order type and which environment they are most effective. We can see on the screen an example of the types of orders available on most platforms. We've got a market buy order, a market sell order, a buy limit order, a sell limit order, a buy stop order, and a sell stop order. Generally, I find that most people have a very good understanding of market buy and sell orders, but they get quite confused when it comes to a buy limit, sell limit, buy stop, or a sell stop order. Let's take a look at each one in more detail. Let's first take a look at market orders. The example on the screen shows an upward trending market. It looks like it will continue to move up over time, and you may consider taking a long position at the current price. You can do so by placing a market buy order, which will buy at the current level instantly, at whatever the market price is. It is important to note that in the currency market, or in any trading market for that matter, if you are trading live and using a market buy price, the price you get could be different from the price that was visible when you press the button. You should always make sure that you check the economic news before entering market orders to be sure that you're not entering at a time where there's an impending economic news release. These events can create what is called slippage, which is basically the difference in price from when you click to what you actually get. In this scenario, you are looking for an increase in price, so you take a long position, and if the market goes higher, you will profit from this trade. Let's now take a look at a market sell order. In the example that we can see on the screen, we have an upward trending market. However, this time we believe that the market is coming down, so you place a sell market order to take a short position. Let's now take a look at buy limit and sell limit orders. In the example on the screen, we have a sideways moving market, but this time we don't want to buy at the current market price. We want to buy at a better price. We still believe that the market is going to continue higher over time, but we want to set what we call a buy limit order. The easiest way to remember this is that if you are setting a limit order, you want to buy at a better price than what is currently available in the market. If you set a buy limit, you are looking for price to firstly come down, hit the limit price, and enter into the market at this level, with the expectation that price will then continue to increase over time, and you will profit from an upward move. Let's now take a look at sell limit orders. The example that we see on the screen again shows a sideways moving market. What if you believed that the market was going to go a little higher, but then was going to come down, potentially while you were asleep or at work? This is where you can use a sell limit order. This order type is useful when you are looking for price to make a new high, or in this case, just a higher point, and then look at profiting from a decrease in price after that point. You can place a sell limit order above the current price, with the expectation that price will then come down once the limit is hit, and you can profit from a decrease in price from this point. Finally, let's take a look at buy stops and sell stops, and see how they differ from limit orders and market orders. The example that we can see on the screen shows a sideways moving market, with potential resistance in front of the current price. If you want to buy into the market at a higher point when the market breaks the overhead resistance, you couldn't do so with a market order or a limit order. However, you could use a buy stop order to execute this entry plan. You can place a buy stop order above the current price, with the expectation that price will then increase over time and continue to move higher after breaking past the resistance zone. This type of order allows you to ensure that the market breaks a significant zone first, before you enter long and put your trade at risk. In the example that we can see on the screen, we have a sideways moving market, with a potential support zone underneath the current price. A sell stop order allows you to place an order below the support zone, with the expectation that price will break through and continue to move lower. Once again, this allows the market to break a critical zone before you put your trade capital at risk.